Hey guys, it's the Market Sniper. We've been talking to you a lot about the strength of the US economy. In fact, from between about a year or 2 years ago, maybe about roughly a year and a half ago, we've been saying the US economy is far weaker than it has been put forward. And in actual fact, we hit the criteria for a recession. In fact, let's refer to this tweet that I've done. It states everything pretty clearly. Before this top end panel that we will play for you off at YouTube in a minute, are actually starting sentences, by the way, as mainstream media people, as I don't want to sound conspiratorial, but isn't that interesting when the mainstream media start to have to qualify their statements, much like we are. The US went into recession, according to us, when it met the criteria for a recession. I know that's a controversial statement. It met the criteria a long time ago, but they told you that's not your reality. It's much better than it seems. The labor market is red hot, was the things Powell was saying sometime before. The red hot labor market. And Yellen, of course, came out and said, it's not a recession. It's not a recession. People who say it's a recession are just wrong. It's almost like you're stupid. Of course. And then there were all chosen ones around her that spoke up and said, it's clearly not a case of it's a recession. And everyone was like, no, that doesn't count. Don't be stupid. The labor. You can't be in a recession when you have a strong labor account. Now, we've regularly referred to the non-farm payrolls, which is coming out this Friday, for which we'll be doing a live trading day, and you can get real trade ideas and our take. News before the news, as we will be illustrating here, about the real strength of the economy and what it means and how you can trade that to make money and build wealth in an absolute wealth flattening environment in terms of where we are now. Anyway, those points aside, they told you the labor market was too strong to be in a recession. They literally overnight disregarded the definition of a recession. And they used labor as the real reason. And the largest labor number that comes out is the monthly non-farm payrolls, which Wall Street always expects very low numbers. And with the birth-death model add-ins, always comes in hugely higher than expected. Especially during quarter one of this year, the data flow was all US is so strong. Quarter two, a little pivot in the data they started to give because people's reality simply wasn't matching the narrative, and they always have to hug the truth. They can't get too far from the truth because eventually it looks like a parallel universe that they're living in. They're already there, but they try not to get too far from the facts. It's amazing how facts about the March 2020 events, biological, you know what I mean? Yeah, well, those seem to be continuing leaking out and bringing us to a real truth. A real truth we warned at the very moment before even those biomedical options were made. We told you what was going to happen. And we told you on this economy 18 months ago at least, and when they first met the criteria for the recession, that they were in recession. You've had Switzerland cut, you've had Europe cut, you've had Canada cut, but no, this is an isolated, strong economy. You've got China already showing lots of weakness, and they make everything for most of what gets distributed here in the States. So why are they doing this? And why are the NFP numbers, Wall Street setting such a low, managed, part of the cartel, don't forget that cartel owns the Fed, which is itself owned by a BlackRock. So the banks own the Fed and BlackRock owns the banks and most other corporations, Vanguard, State Street as well. So it's all an inner cabal. I've been running it and saying, wow, we beat the number and the expectations. We've been saying and calling it the fake number, which the market initially reacts to every time or is encouraged to by the banks that push the market and the currencies up. So you end up having to chase the momentum of their narrative rather than the real facts. And then a month or two later, that same number gets manipulated down and changed, or less manipulated, one might say, reset down substantially lower. So the initial reaction to the news is what's remembered by the market, and there isn't a contractionary effect later when old numbers get reverted, because this time this number is good. You can see we fixed the old numbers, but now this one, this non-farm payroll, this one coming on Friday, which you'll be joining us for a live trading session. That's right. And you will be getting trades, fast breaking, real low risk we'll be looking at. And I'll give you a clue as to one that I'm going to be watching in this video as well, which will be talking about the possibility of oil going back to the 40s. Yes, and potential for further overperformance to the downside. Who knows? Who knows? We'll show you that in a minute. But first, let's cover the economic narrative that they've spun. Why have they done this? And why did we state many months and moons ago that they're going to waterboard you and hold your head under for a lot longer? Because rates have always been cut to save the US consumer, and they've been cut right down to zero in many instances. How and why won't that happen this time? Because nobody will buy the record debt issuance at current prices, never mind the higher prices that rate cuts imply. Remember the Substack. For the rates to go down, to push the treasuries up in value, whether it's the yen, whether it's the dollar, it is a seesaw. If you want to take your rates down, people have to be prepared to buy and bid up the treasury market. That means they are choosing it as an investment. And as you know, we credit ourselves for being the original callers of the turn in the debt cycle. That's right. The original callers as early as August 2020, we drew it for you here. Let's go and have a look at it. TLT, the short callers over here in a blow-off rate-based environment. So during a period, this is pre the head and shoulders that further asserted our downside. In that circled area, we had the first inverted HVF on a 40-year bull market that would bring you all the way down to a neckline we expected could see a bounce. It was a bigger bounce than we expected, but nonetheless, it gave us the head and shoulder and re-gave the short to the downside for debt. You could have been short from 160 in a market that is well below 100 today and can't reclaim it and is currently on a broadening structure on it after a down leg. In short, the debt market has turned, and if we just take you up a time frame, it took 40 years to create this bull market. It will take far less in its unwind, I'm afraid to say. And I will show you the extent that we have data on the TLT. Remember, the TLT is an ETF of 30 years, 20 plus duration, long-term debt, up, debt markets up. It was the foundation of the 40-60 portfolio, 60% equities, 40% bonds, that suddenly stopped working after this call we gave in 2020. And actually you got terrible equity performance in the CV19 sell-off, as well as terrible bond performance. Even worse bond performance than you'd ever had in almost all of history. And suddenly, that theory that barrel-chested Tony Robbins stood as he entered the financial sphere and interviewed all the heroes of industry suddenly brought and made available to all the masses the secret of Wall Street just as it stopped working. Yes, just like stablecoins suddenly get left alone from being pursued by the Federal Reserve and everything else once they became buyers of treasuries instead as collateral. What an unbelievable. It's amazing the minute you put a bid under their debt Ponzi, how they leave you alone. Indeed, indeed. And it's amazing how Wall Street gave up the secrets surrounding the 60-40 portfolio that Tony did write up for you so nicely in his book, Mr. Retail, Get Your Life in Order, Do Bench Press and Be Awesome, and Shout Loud and Have a Deep Voice. Let it resonate. Resonate. I want to send vibrations with the depth of my voice that your cells shudder in awe and respect of my unbelievable charisma. That's right. Anyway, he is quite charismatic and I actually like him, but he's not a timer of markets, that's for sure. And so with that said, we actually have a turning of a market, and 40 years up, my friend, that is escalator. It's elevator down. It is elevator down, far faster unwind. And it's because of that reason. And don't forget, as illustrated in our Substack article, still one of the most important ones with diagrams. We went to a bit of effort to do some diagrams for you. China is divesting. Who is the big buyer? Well, if it's not the Federal Reserve, it's probably going to be UK, Belgium, bullied little Japan, even though they have the debt problems of their own, and more Belgium. The Belgium waffle is going to be big on the debt market. Toxic bank. The toxic bank of buying a debt instrument that nobody wants. How do you cut rates when nobody wants to buy the asset, reducing the lower yield. The risk-free premium of my MBA era is a risk-free no more, and we called that. There's too much debt around, and most of the debt, as you will have seen with our David Wu interview, is being put, 75% of it, on short-term bills. That is all coming due again and again and again, because they didn't want to push the long-term yield rates up by providing ever more supply. What would that do? Well, if you push the long-term yield rates, our current inversion on the yield curve inversion would revert back above zero. But hark, that's happening anyway, even with Granny Yellen Yoda putting it all on the front end, all that 75% of the new debt. That means you do a lot of flipping. It's kind of like putting your 30-year mortgage on your monthly credit card that requires you to settle every month. Well, you do a whole bunch of rolling it on different credit cards when you don't have it on long-term debt. And that's all to preserve the rates from not going higher still on the long end, for which the market will not tolerate higher prices for bonds and lower rates. So you start offering more and more, the rates will go up and the values even further down. We are in a debt trap. The US, my friends, is a debt trap, and I always bring it back to this thing. You are part and parcel of a debt collapse. People will confuse you and baffle you. I'll bring it back to the simple, hard fact. A debt collapse. That which is proliferated forever and infinity in any scale you want cannot be valuable. Scarcity is a component of value. That can be had by everyone and all, and any amount they care cannot be valuable, ready to be distributed at any point. The consumer therefore must face the stagflation pain of consistent higher rates as a recession rolls into a depression, and the only way we get out of that by this banker-induced depression, much like 1933, is quite likely a world war where ever greater status expenditure will still be added on the military-industrial complex, pandemic attack vectors, the pharmaceutical attack vectors, and all the other statist oligopolies and monopolies that are being earning out of government expenditure. Also, the point made in this YouTube video that we will play for you in a bit is also that most of the jobs, 81%, once you count government employment and other touristic, which is non-value add to the economy, jobs that are being put in there are largely statist of component, and that is not productive expenditure. So if the government keeps hiring, that is not job creation, my friends. That is cost creation, additional fixed cost creation. That is it. That is like you hiring cleaners and butlers and drivers for your car when you are already deep in the red in the credit card with your 4-person family. It's not sending your wife out to work and getting additional income. It is adding further fixed costs to an already failing credit system. They're doing exactly the opposite to what they should be doing. And as a result, watch out below. Watch out below indeed. Let's listen to the video from, I don't want to sound
You're spot on, Jeff, when it comes to the reporting part of this. And I don't want to sound too conspiratorial, but first I think the fix begins with the Wall Street's consensus. It's always like a number that's kind of lowish. And, oh, we beat Wall Street's consensus. The economy is strong. That doesn't mean the economy is strong, right? I mean, it's so I'm sitting there last Friday. I think the jobs number came out last Friday. Yep. I'm on a panel and everyone starts to regurgitate. The economy is strong. The economy is strong. So I'm going through it. I'm like, well, can we be strong when 680,000 fewer people are working? Wait a minute, hold on. Can we be strong when 640,000 people drop out the labor force? Is that the definition of a strong economy? But regurgitate. Then you've got the headlines, then the algorithms go to work. Stocks go up, bond yields go down, but by the close, that stuff kind of fits itself a little bit, but it happens every single day. And by the way, great workout from the National Bureau of Economic Research in December on just these macroeconomic news events, how much more impactful they are versus just good old-fashioned fundamental research. That's why so many people are so frustrated. I think 44 events a year contribute 71% of the market moves.
create 71% of the market moves. So you heard and understood the first part of that, but they create hype news events in and around particularly the non-farm payrolls, which is why we like to trade it and see how the data is trending. The data lie, and we've called it the fake number many times. By the way, click the link below. Join us for the live trading day session. Find out about all our other trades. Is the US economy strong like they say? Even the mainstream pundits are now starting to ask. By the way, as we mentioned, Jerome Powell, now when he was calling red hot labor market, now talking about, well, NFP does overstate a bit. The liar stat, even they now are beginning to admit, because of the diversion from reality that is undermining their credibility. You see, even liars need to say somewhere close to the coast of truth, because eventually they get found out. That's right. That's what's happening. So what is one of the potential trades of interest? Well, for those of you that say, I won't join your live trading day, there can't be any value. Why does it cost $195? I don't want to do that. Well, you can watch the oil market. I'll give you this for free. There'll be other things we'll discuss in far greater detail, other ideas that we'll cover both in the traditional market section, which is an hour and a half before a short break, and another hour and a half on the crypto session, which you'll get recorded, by the way, and can watch for the full month. And if you get 3 for the price of 2, you will have 3 months of access to all the recordings of all 3 on both the traditional markets and the crypto markets to carry you through this period where even the mainstream media is breaking away, or certainly YouTube semi-mainstream media panel is starting to question the narratives that you are being provided. So overall, this is oil pivoting around the 80, failing to hold above. You will note the long flat grind line along the lows. You will see a steeper line across the top. You will also note the reduced ability to remain above the $80 mark, and this is setting up for potentially, and we can see we had drawn a possibility of a W upside. No, the market is showing us softness and showing us weakness. Our current bias would be exactly the opposite, and we show all our draws because we scenario cast, we don't bias. We let the market tell us, and if that low is our third low, in fact I'm going to move that to there. Let's say we bottom here and have a weak rally before going down as part and parcel of this. We would see this as, one more time, I'll get it right, that's it, one more time, as an inverted HVF for downside, for which we would see the target of this at around low 50s. Here we have 52.5, but the potential to go into the 40s as part and parcel of a spill being very real because of demand destruction, debt choking, statist crowding out of small businesses, medium-sized businesses in all the industries that we've already mentioned, the military industrial complex, the surveillance finance complex of Apple, Google, Android, of course the chips of Nvidia, Amazon, and the rest of the psychopaths, and the BlackRock containment of all these assets and manufacturing the narrative that you've never had it so good. There's a red hot labor economy when we've clearly not been in a strong position. And despite oil price production cuts that is price supportive, I feel the events in terms of the economy are about to deteriorate, and that this could be a short opportunity, which once again, and by the way, we've called short not many times, macro shorts on this oil market. And we are the only one known that I know that called the short up top here in and around the 60s for the spill. That's right, that wick went to 0 and we said single digits. We also called short, let's take it off log scale because the chart's kind of ridiculous, over here. After initially feeling it was going to be an upside continuation long. And by the way, that was during the 2014 Ukraine-Russia initial crisis. So here you go, 2 short calls on oil. One that ran the lows of what was a subprime depression. We don't do normal recessions. That short call, and the other that took oil for the first time in around 30 years to single digits, which in one instance was in fact 0. So by calling short here, it's probably the third meaningful big time frame in my trading career that we are making big statements like this for oil. So you are probably looking at a short call, and that's why we suspect that 52 could indeed be overperformed to on the downside. The only saving grace is that last time Russia and OPEC competed against each other and they glutted the market to keep extracting revenue. They have been showing a greater degree of cooperation in terms of cuts and have done 2 cuts collectively to preserve the oil price in maintaining it here. But if things escalate quickly, even production cuts will not stop the demand, the delivery, and everything else pertaining to the economy taking a downside move. This is likely to switch the gold versus oil ratio. Many people forget that we were actually a long gold caller there, and that the gold had a very short and quick dip and then went into a bull run that ended in the 2021 high on the basis of proliferation of fiat that followed. Okay, guys, let's leave you with that. Join us on our live trading day this Friday coming. That's right. I'm looking forward to doing it with you. And we will be going over the core markets, core markets, potential trades to build wealth in a teetering economy that even, as I say, the talking heads on YouTube are starting to say, well, maybe it ain't right that we keep getting revisions to the downside on the non-farm payroll. Maybe it ain't right that Wall Street always undershoots and lowballs for a beat. Hooray, we're strong. Maybe it ain't right. Maybe those labor stats are lies, damn lies, and statistics. Catch you later. Thanks for watching.